The stock market is currently active, and B2Gold Corp, trading under the ticker BTG, is sitting at $4.01, reflecting a minus $0.03 move or a decline of about minus 0.74% from the previous close as of the current intraday session. Now, the common expectation right now, especially following their Q3 earnings report yesterday after the market closed and before their current live earnings call, is a sort of muted optimism. The market narrative suggests that higher gold prices, which we've seen recently, should naturally boost a gold producer like B2Gold, and that the stock's recent pullback has been an overreaction. This is the simple investor's logic, the one you'd hear chatting over coffee. Gold is up, so BTG should be too. But the initial price action this morning, opening lower and struggling to maintain $4.10, tells a much more complicated and frankly more insightful story. The reality that the market is struggling to process and the insight that should hold your attention is the deeply rooted geopolitical risk factor in Mali, coupled with a specific disappointment on the earnings front that is overshadowing the positive gold price tailwind. The headline is that the adjusted earnings per share of 14 cents missed the Zacks consensus estimate of 15 cents, even with revenue coming in strong at nearly $783 million. The market saw a slight miss on the bottom line, and in the current skittish environment, a miss is a miss, regardless of the quality of the underlying operational performance. The tension is really between the operational strength that B2Gold continues to demonstrate and the overwhelming external risks it faces. Most investors are aware that BTG has a significant asset, the Fekola Mine, located in Mali. However, the true weight of that political risk is often under-discounted, and the recent news that the company had to issue a public statement confirming that their operations at Fekola continue unimpeded speaks volumes about the instability in the region. This isn't just a minor headline. Is it a live existential risk for a company that relies heavily on a single asset's production? The stock's dramatic drop of over 9% in the last 3 trading days leading up to the earnings report wasn't just pre-earnings jitters, it was a clear institutional repricing of this persistent country risk, and the recent after-hours movement, despite the strong gold environment, confirms this deep-seated concern. When you combine that geopolitical worry with the fact that their Q3 adjusted earnings missed expectations, albeit narrowly, it acts like a double punch, immediately wiping away the benefits of a robust gold price environment. The current low $4.01 price point, struggling to hold the line, reflects a market that is selling the narrow miss and selling the persistent political anxiety, not buying the gold price rebound. Looking deeper into the recent stock movement, the daily trading volume has been exceptionally high, suggesting a significant amount of institutional repositioning and active trading, not just passive holding. We saw volume spike to nearly 50 million shares yesterday, which is well above the average and a clear sign of big money moving around. This kind of heavy, high-volume action in the face of a slight earnings miss and a geopolitical risk flag indicates a lack of conviction from some larger holders. Institutions like Van Eck, FMR LLC, and Vanguard, which hold massive stakes, are always evaluating risk exposure in their portfolios, and the recent volatility in the region forces a fresh look at the risk-reward calculation for holding a stock like BTG. It's a very different equation than holding an American tech giant like Apple stock or a semiconductor behemoth like Nvidia stock, where the operational and political stability is largely assumed. For BTG, the risk premium on that 0.14 EPS miss is amplified by the political backdrop. This is why the price is showing weakness despite gold itself being relatively firm. Furthermore, the company's recent Q3 results, while showing strong revenue and cash flow from operations, also included a higher all-in sustaining cost (AISC) figure compared to some peers, which is a critical metric in mining. Although the costs are within their annual guidance, the market punishes cost increases, especially in a sector facing generalized inflationary pressure. The expectation was that the high-grade ore from Fekola underground would offset these pressures more aggressively, and the market's current reaction suggests disappointment in the margin performance. The foundational business of B2Gold Corp, for those less familiar, is straightforward. They are a Canadian-based, low-cost international senior gold producer. They own and operate gold mines across the globe, primarily in Mali, Namibia, and the Philippines. The company's strategy has always centered on acquiring and developing mineral properties with low operating costs and high margins. Their primary operations include the Fekola Mine in Mali, the Masbate Mine in the Philippines, and the Otjikoto Mine in Namibia. Fekola is their crown jewel, a massive low-cost operation that drives the bulk of their production and, consequently, the bulk of their risk. This high concentration in a single politically sensitive jurisdiction is the crux of the expectation versus reality dynamic for the stock. The expectation is low-cost production. The reality is the constant threat of government changes, license issues, or civil unrest, which requires a constant stream of reassuring press releases like the one they issued just days ago. The company also has a solid development investment in the Goose project in northern Canada, which is key to their future growth and diversification efforts away from Africa. Their history is one of aggressive growth through acquisition and development, successfully transitioning from a smaller producer to a senior one. They've historically paid a consistent dividend, another factor that appeals to a certain segment of the retail investor base, perhaps those managing their assets through an individual brokerage or utilizing simple tools like Schwab Intelligent Portfolios or SoFi Invest. A deeper technical look shows that the stock has been technically struggling even before the slight earnings disappointment. The 50-day moving average, a common technical support level, has been broken, and the stock is trading near the lower end of its recent 52-week range, closer to $2.20 than its high of $5.94. This downward momentum is exactly what you see when institutional investors are trimming positions or taking profits due to increased risk, and it contrasts sharply with the popular retail belief that a gold stock should be thriving in the current macroeconomic environment of high inflation and geopolitical friction, which typically pushes the price of gold higher. For those practicing self-investing or relying on accessible platforms like the Robinhood app, the price decline might look like a simple buying opportunity, a dip to invest online. But the complexity lies in the volume and the institutional activity, suggesting a deeper problem. This is a moment where a simple valuation metric found on an online investing site might mislead an investor who isn't factoring in the specific geopolitical premium being added to the stock's risk profile. It serves as a great example of why a more comprehensive platform like Interactive Brokers Trading is often needed for sophisticated analysis of international stocks. The future outlook for BTG is a delicate balancing act. The expectation for 2025 is for strong consolidated production, guided between 970,000 and 1,075,000 ounces, which is a great number and provides a very clear tailwind if gold prices remain elevated. The reality, however, is that a significant portion of that production is contingent on stable operations in Mali and the timely receipt of the Fekola Regional exploitation permit, which is noted as being in the final stages of approval. The commencement of gold production at the new Goose project in Canada is a massive catalyst for long-term de-risking and growth, giving them a high-quality asset in a stable jurisdiction. If they execute on Goose, the entire risk profile of the company changes, moving it further away from a reliance on the Malian assets. This is the opportunity that keeps the bulls interested. However, the primary risk remains the potential for further cost inflation to erode margins and, critically, any further destabilization in Mali, which could lead to disruptions far more significant than a slight EPS miss. The market's initial reaction of selling after the Q3 report, even with the positive revenue, underscores the nervousness. It's an environment where good execution is merely the bare minimum, and any slippage, even the single-cent miss on the consensus EPS, is amplified into a reason to sell. The smart money is looking past the current gold price and focusing squarely on operational efficiency and country risk management. Investors using a variety of investing sites and platforms, from Fidelity's comprehensive offerings like Fidelity ETFs and Fidelity mutual funds, to the more direct interface of the Robinhood stock trading platform need to understand that the narrative is not just about the price of gold, it's about the cost of digging it up and the political risk of the ground it comes from. For B2Gold, the path forward is tied to the successful commissioning of Canadian assets and a steady, cost-controlled operation in Africa. Comment below how many shares of B2Gold Corp, BTG, you currently hold, or if the geopolitical risk is too high for you to consider adding a gold stock like this to your portfolio right now. The final verdict here is that the general expectation of a gold producer automatically riding the coattails of gold prices is being sharply challenged by the specific and largely unhedgeable geopolitical reality that B2Gold is managing, making the stock's performance a story of tension between commodity price buoyancy and regional instability. The company's fundamentals are largely sound, but the external factors are casting a